Today we're talking about the UK employment and wage data and what that means for UK interest rates. And then we're going to move on to something that we rarely actually talk about, which is the Swiss National Bank and the fact that they've left rate hikes on the table. What does that mean for dollar Swissy? And then the trading takeout today is going to be, it's never actually too late to buy quality stocks. I'm going to show you exactly what I mean by that. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So here we go. You can see here, and here is the UK unemployment data and wage data, in fact, so earnings data too. And it's an inflationary bag. Because if you note here, we've got UK average weekly earnings on a quarterly basis is up 7.9% with the expected at 7.4%. The UK ILO unemployment rate, which there is an asterisk next to this as well for a reason, not the actual asterisk, but another one. That's down on the actual at 4.2% versus the expected at 4.3%. UK average earnings, excluding bonuses, was bang in line, 7.7% versus 7.7% expected. But this unemployment rate is important to note because there's actually been a change in the methodology. So it's not necessarily comparable. Not the unemployment rate, the employment change is not necessarily comparable versus last month's data. Okay, so we're going to have to look at next month really to get a better picture. But off the back of this, it's inflationary purely because, if you think of the traditional, what's known as Phillips curve, if unemployment is decreasing, then inflation ticks up at the same time. However, at the same time as this, you've got wage data also increasing. So there's kind of a double whammy there. So you can see from a cable chart here, you can see exactly where the data came out at 7 a.m. And if we just throw a little line across there, came back perfectly tested as support. So data breaks the range, technicals come into play, uses the range high as support. We've now got a couple more levels just above here to note. And I think the target for today is likely going to be upside levels here. So 1.231, breaking through that 1.23 level properly, so targeting here. From a broader perspective, you could argue that this is sort of a cup and handle situation here. You've got bottoming pattern, price springs through the support there. There's another support here. So there's a major support that it comes off of, sort of an over-under pattern. And then we're looking to trade back up to the range highs up here. The market is not discounting. I think if we look at News Squawk here, the market's not discounting the fact that there could be some sort of bullishness in interest rates here. So I'm talking here about interest rate hikes coming back onto the table in the short term, but you can see here that, there is a sort of, how do I put it, two confounding problems here with regards to what they're actually saying at the BOE versus what this data suggests. So Pill, you can see here from News Corp, Pill and Dingra have been speaking. Pill's been quite dovish. Dingra's been very dovish as well. This could spark more confusion and uncertainty in the market. But right now, the data in the market is in control. You can see that through sterling ticking up, and it has considered these data points as inflationary and hawkish. So the chief of the Swiss National Bank, Jordan, has come out and said he will not hesitate to tighten monetary policy further if necessary. At the next meeting, they will review whether measures taken to date are sufficient to keep inflation within price stability range on a sustainable basis. So effectively what he's saying is we're willing to hike. You know, if he thinks that inflationary pressures are going to become too much still, or they haven't done enough, then they're going to hike again. Makes perfect sense. They've got perfect ability to do so. You know, Switzerland is very different to many other economies in that it's just insanely highly developed in terms of you know, wage growth, in terms of quality of living, in terms of all of these things. So there'd be a fair way to fall if they did get things wrong, let's put it that way, but I don't think they will. They've got a very specific political positioning in the world as well, which makes them a very, very interesting and unique nation, actually. Now, when we're looking at this, we have to look then at dollar Swiss. It makes the most sense to look at everything through the lens of dollar Swiss. Let's zoom out a tiny bit. And you can see here that we look like we're actually on a bit of a turn anyway. And these comments are quite insightful, because what that then means is that we can say, oh, okay, so we've got quite a nice confirmation here, sort of a bearish flag pattern going on, or some kind of trend break. Plus, right at the support level, we've got comments coming out. That's a perfect example of how to work through using the macro and the technicals at the same time, or some sort of event-driven stuff. Now, the way that I would possibly play this, if you were to be bearish, is I'd look for, you know, strong momentum through here. Let's even see if there's a moving average at all. So if we go here and then we shove on inputs, let's go to daily and then chuck on the 200. Let's hope the 200 daily moving average is nice and close. So we are quite close to the 200 daily moving average, which is even better. What we probably want to do here is wait for the market to drop through and see what this does at the 200 daily moving average, with the understanding in mind that the Swiss National Bank is open to rate hikes. Because if we're aligning the technicals there, the longer term technicals, with this prediction that they might actually come back online with rate hikes, then there's a perfect opportunity there for lower prices. You know, obviously dollar Swiss, if you're bullish Swiss franc, then you're bearish dollar Swiss, right? And so the best thing to do here, in my view, would be to look and wait for a confirmation underneath here, because you don't really want to get stuck in a position where, you know, price is sort of meandering around here, but then you don't get the sufficient follow through. And in case, you know, it obviously ticks back up. But if you look at dollar Swiss over the longer term, it's pretty much always going down. So the longer term trend is to the downside anyway. So you've got that in your favor too. You know, there's another net benefit with the Swiss franc, is that if you think we are going to go into maybe a recession soon, or people are pricing in some sort of, not necessarily liquidity crisis, because that would be bullish the dollar, but if people are pricing in a form of, I guess let's call it a crisis, a financial crisis, then people are going to flock to Swiss franc as a safe haven. They normally do. I would prefer in that case, though, to play it short Euro Swiss. That is probably the better play, because then you're getting rid of the safe haven of the dollar and you're just trading the weakness of the euro versus the strength of the Swiss franc in that case. But for now, I think, yeah, let's just wait and see what happens under this 200 daily moving average here, and then see if there's any kind of confirmation of your own metrics that should lead to lower prices on the dollar Swiss pair. So I was having a chat with a mate just this week, and we were talking about this stock, Novo Nordisk, and I said, yeah, I really like it, I'll hold it. And his response was, aren't I a little too late to enter Novo? Novo obviously being the stock. And I just thought for a second, I said, okay, right, let me just show you this chart, okay? And so I sent this to him, and he was like, yeah, that makes perfect sense. When you're looking at quality and you're looking at demand and you're looking at, you know, whether a stock is a good business or not, whether it's gone up, you know, massively in a short period doesn't necessarily matter. especially if you're looking at maybe a 5, 10, 15-year time frame in some cases. You know, the problem with being a trader in the short term and then thinking about your passive portfolio, which everyone should maintain one, by the way, is that you kind of get stuck in two different biases. You're like, oh, but this stock's gone up. There's momentum behind it. It's going to fade soon. Oh, I need to get out. And you start crying and, you know, worrying too much. And then when there's the more sort of passive side, and then you go back to trading, you're like, oh no, I'm holding this for too long now because it's meant to be a trade, and you get stuck in, you know, holding a position for too long, or worrying about holding a position for too long because you need to be in and out of the market and all of this nonsense. When in reality, you can do both. But when it comes to passive and you're holding quality stocks, time frame is irrelevant, especially if you're receiving dividends as well, because they can compound. So always bear that in mind, that just because something's gone up quickly, if it's quality and the fundamentals are still there, it's irrelevant. It's completely irrelevant, especially when there is strong foresight and strong guidance for the future.